corporate VC and not keep on with like the Kleiner Perkins and the Greylocks of the world? What's the difference there?
I mean, the bottom line is I made a mistake. I left Kleiner Perkins in a hurry because I didn't become a partner fast enough, and I think that was also part of my personality when I was very young. Everything came really easy to me very, very early, and I actually misread the signs. I was on the partner track, but I somehow convinced myself I was never going to happen, and I was at that time where I knew a lot about some hot area of technology that seems trivial right now, and so I was recruited by IBM, who thought it wanted to start a venture fund and extend. This was back when not every personal computer had audio or video capabilities. So it was kind of at the dawn of multimedia, pre-internet, back in last century in ancient history. But I had turned down an offer with Microsoft, which was ironic. But anyway, I knew a lot about the PC industry as it was evolving. I met a lot of executives at IBM, and somehow that led to this opportunity. And so when it seemed like that was the next, at the time, that was a build something from scratch opportunity. The other thing I learned about myself is that personally, I don't like being the 12th guy in some group that already has figured out how to operate. You know, more or less, it's partnerships are funny animals. Not that I'm probably telling you more about venture than you want to know, but venture partnerships tend to hire in their own image. They hire men and women, roughly speaking, like themselves. They don't go for crazy ass ideas that rock the boat. And also, when you join as the 11th or 12th person, you have to fit into the way they do things and the way they operate. And a lot of the spaces that are interesting that you may want to explore and exploit as real estate in that metaphor, those are already staked out. So you get what's left, what hasn't been staked out, and you generally are trying to fight for that plot and keep other partners from encroaching, going, oh, yeah, that's a great way to make money. Let me take it away from the junior guy.
Yeah.
So there's a bit of a, get away from my space thing. And in corporate venture, at least all those opportunities, I had the opportunity to build something from scratch, which I guess kind of goes back to the startup mentality. I like blank pieces of paper in terms of strategy. Those are much more interesting puzzles where nobody has anything, nobody knows what to do. As opposed to, there's only a few moves left on the chessboard and it's going to end soon and you just have to move the pieces. That's not so interesting to me.
No, I'm the same way. I totally agree. And it is very different, even working between a VC and a corporate VC as a startup, which kind of brings me to the next thing. So, so with GE, why did GE decide to get into?
Why the hell did I do that? In 2011, late 2011, I was running LG Electronics global venture fund, which it had ceased being interesting and had started to be kind of a not so fun. So I was looking around. And when I read that GE had this vision for transforming the industrial world by really rocking the boat and exploiting all the data that they had access to with all the buzzwords that were cool at the time, big data and AI and now IoT. And I just thought that was the craziest, most ambitious idea I had come across. They didn't have an agenda for venture. So I really forced myself on Bill Rue, the guy who ran GE Digital. I knew the people that he used to work for at Cisco and got introduced to him that way. I think his first words to me were, Mike, who the hell are you? Why have you called all the people that I used to report to? And, why should I kick you out of my office? And basically I said, I needed to meet you and explain to you that if you try and do all this stuff yourself, right, hire all these people, figure out which GE people are appropriate, and then figure out which new people make sense and merge all that together and try and write all the software yourself, it's not going to work. You really owe yourself a favor to leverage the rest of the innovation economy. And so you need me to be out there sensing what's going on, maybe hedging internal efforts that the company is trying to pull off on its own, or maybe shoot ahead of the target just in case something works out, and you can incorporate that into the roadmap, the very ambitious roadmap that they had. In fact, they were still building the roadmap. They had a vision, but they wasn't clear how they were going to pull it off.
So one of the that's actually one of the questions I had was like, before industrial started investing in startups, it's quite common if you're a startup and you go to a big industrial company, they'll kick you out, right? It's like, you're not big enough for us or whatever. Like, why did they decide to invest in startups, and what did it take for you to actually change that mentality of, or what were they already there?
Why did GE? I think it wasn't solely because of me. I didn't change their mind. I was fortunate in my timing because the board of directors, they had previously, for about a year, the board had been wrestling with this opportunity that was being promoted internally. The opportunity, they had seen that the margins on making stuff were compressing, but they also noticed that the margins on the service revenue, where they sold a contract for 10 or 20 or 30 years to maintain the gas turbine that they sold to somebody, those margins were pretty healthy, much healthier than the margins on the physical stuff. And they had an example in, I think, aviation, it was, where they were able to expand the margins or control the margin compression through the use of data. So if you sell somebody, if I say, I'll guarantee that your engine works as much as possible over the next 10 years, but I'll take all the risk. All of a sudden, you're very interested in being efficient. And the aviation company had been using data that they've been collecting from the jet engines to do some smart things, like don't be surprised by when the engine needs servicing, make good predictions, and arrange lots of other things to do while the engine is off the wing, because you might as well do some other things to it and clean it up. And be thoughtful about engines that are, this is a apocryphal story, but seems silly in hindsight. Engines flown on routes that have a lot of particulate matter in the air, like in the Middle East, tend to degrade quicker than engines that fly polar routes from, say, London to San Francisco, because most of that air is much cleaner and less corrosive to the blades. And once they started figuring that out, they could keep more of the money they were being paid for service. So the board said, what if we did that for more of the business units, all of the equipment we made? What else could we do if we exploited data? So the company was already in the mode of trying to exploit that. That's why they set up digital. I think, were fortunate enough, Bill Rue had convinced them to locate it in Silicon Valley. So they kind of were halfway towards, well, if you're going to be in Silicon Valley, or at least the East Bay, which is nominally not really Silicon Valley, but you weren't supposed to mention that if you were at digital. You might as well take advantage of other startups, not just hire, so GE's most big industrial companies at that point, their technology innovation strategy was hire smart people into our company, or promote existing smart people and retrain them. And I think what they realized is most of the world's smart people don't work at your company, but they might be convinced to share what they're doing in a collaborative economic way. So then the board had already secretly decided to set up something that was called GE Ventures, which is focused on everything but software, which got announced about 2 weeks after I joined. And so it was a little bit awkward for me to explain why we had 2 venture funds. We just papered over that and pretended it was one venture fund until we could smush them together. But I'm just fortunate that the company had decided just before I got there that it really was important to reach out and exploit innovation happening outside the company, not just via venture investing, but that was one of the important tools.
Yeah, cool. So I know, we've talked about this. So IoT, it spans the entire stack, right? You've got hardware stuff. Yeah. It's got hardware. It's got software. Where I know, you mentioned to me in the past that you haven't invested in hardware, but in general, is that something that a company like GE would do? Right? Would they look at the entire stack? And second, how do they actually decide where to go invest? So how do they look at the market? Who decides that?
Yeah. First, a joke. I used to say that inside IoT, inside GE, IoT meant Internet of Our Things. And by that point, all the high value assets, those things that were tens of thousands, hundreds of thousands, or maybe tens of millions of dollars in value, already had embedded sensors, because the incremental cost is trivial. So why not? Why not sense everything as much as you could? So GE already had let's call it a sensor agenda that I didn't have to convince them of. And they just had a lot of data that was being stored in various silos that wasn't particularly clean or well exploited, except for some lesser value applications. Historically, we stayed away we looked at a couple of hardware-centric things, but we really stayed away from that. I think it was mostly cultural, because as an engineering company, when you bring an idea to a big company, there's always a group of people that says, "Oh, that's interesting. We can do that too. That's not that hard." And it's much more common in an engineering company for somebody to say, at least a big one like GE, to say, it's just a sensor. Well, in fact, GE already had a captive sensor and analytics company called Bentley, Nevada, which was really sophisticated at vibration sensing and super high rotating machinery. So it's kind of occasionally they acquired something, but anyway, it was the idea of investing in a startup sensor company wasn't particularly well received, so we just politically stayed away from that entirely. We did invest. If you look at the whole stack in this imaginary technology metaphor, the industrial solutions are much more complicated generally than selling books on Amazon. At least the possibility for confusing inaccurate data goes off the charts. And so there were many problems with the stack you wished you had. Either the pieces didn't exist, or there were bottlenecks as you sensed the data from wherever it was and had to move it to where you wished it was, so you could compute something with whatever computer was where you wished it was. And then you still had to dream up some analytics that worked on that kind of data, which, generally speaking, multivariate time series data is a different level of analytics than most people, who go work for Facebook or Google get recruited to focus on. So there's a variety of problems within that stack that needed to be addressed. The way I decided what to invest was there was about 55 different strategies that rolled up into whatever GE Digital's strategy was.
Mm-hmm.
And it changed. It was very fluid, as you probably remember.
Mm-hmm.
So there's the evolving fluid strategy this week of what everybody thought the priorities were and when they needed to be delivered. There's also a org chart of people who are too busy. They got too much to do, and occasionally some of them were willing to be receptive and wanted to be helped. But also not too infrequently, there were people who were just too busy to be nice or bother to be responsive. And so I developed this philosophy of, life's too short to try and help people that don't want to be helped.
Yeah.
So if I found a company, but I knew the receptor side, if you will, was managed by a person who just his or her hair wasn't on fire about a particular issue.
Right.
I'd just park it and maybe come back to it. I would come back every 6 months and say, hey, do you still have that problem? Or, who's the new person that runs this group? Because often there was org chart there. But I had to figure out what's happening in the startup world. When might it be relevant to this strategy roadmap? And there are lots. That was pretty easy because there's always gaps there. But then who feels like they can be helped right now, or who's underwater and can't afford to be helped. That was, that simultaneous equation was a little challenging.
Yeah. So is that so? Was that common with the other places as well? LG, Orange, IBM, or was that unique to GE?
No, I think it was in the growth level. It's common. I mean, each large corporation has a different. If I could oversimplify and reduce it to those three things, I think I was fortunate that GE actually had pretty detailed roadmaps, where they had, people who were responsible for a reasonable chunk of the roadmap, and so their heads didn't explode when they had to try and figure out what the problem was. Other companies I work for, the roadmap is really vague, and so there's a lot more persuasion about, hey, you ought to have a roadmap and this ought to be on the roadmap, because if you don't evolve your product, somebody's going to put this business out of business. The who wants to be helped dimension seems to always be true, because I think that's human nature. Some people have time and other people don't. They're really busy. But the crispness of the roadmap, I think that was my huge advantage. I appear much smarter and cogent about the evolution of industrial IoT because the company had a very strong vision that it was trying to execute against. So I'm probably still the most active investor in industrial IoT, even though I haven't made a new investment for about a year, just because there were enough gaps that GE was receptive to making bets on that it was easy to follow that roadmap.
So in terms of startups engaging with a corporate VC, where do you think they should start? Should they start with someone like you, or should they start with the person who actually needs the help?
There's no right answer. I mean, it depends is the answer.
Okay. Yeah.
Because if it's a conversation with the corporate venture capital team, what you, the founder or CEO of this company, have to determine is, can this person help me? Does this person, you want to see through the person to, is the company have a roadmap and do they have anybody that wants to engage with me? But you're stuck with this person and you got to figure out, do they know what's going on? Can they make something happen? Can they persuade? Can they change somebody's mind? Can they get me a meeting? Is, I guess, the basic stuff.
Right.
And that you don't know that until you, maybe by reputation, you might know that. But that's, it takes a while to figure that out. On the other hand, if you have and so you have to build that relationship. But if you have a connection on the company side, that can be great because you've got a motivated person that wants to be helped and thinks you've got something they need. Or it could be a tar pit, right? That you can be stuck in a POC forever that never resolves.
Yep.
And so there's just a different set of, it does focus on, okay, this corporate person, is this a tar pit, or does this person actually want to make a decision that I can be part of? And that's not going to be obvious either. So you have to sort of feel it out. You need somebody or group of people that can help shepherd you through the process that's not very clear. You need a friend, and that's up to you to figure out if that friend is your sponsor, the kind of business owner, business problem owner, or the corporate venture person, or some other partnership person, or some combination of all three. Ideally, it's everybody, right? They're all on your team, but you got to figure out who you trust and then recruit them to do work on your behalf.
Yeah, I mean that was one of the things that I think in terms of engaging with a corporate VC, it's much more like a sales type of opportunity where you have to build a guiding coalition, ideally with multiple people. Whereas a VC, you're trying to convince one person who then goes and convinces everyone else that we should invest here, right? Or I mean, you could do. I mean, how is that different? Like in terms of engagement from your perspective?
I think that's more true than not true, but there is eventually a decision process about an investment.
Yeah.
So which is also situational, and it depends on which corporate venture firm and which corporation. So we had GE Ventures. I guess most of the things that I've led, I had the authority to make an investment decision up to some crazy amount of money. So that's a person that can make something happen, or a team. The corporate venture team has a decision process, and they can make something happen. Other firms, they can't make an investment unless there's a sponsor and a business unit who endorses it and protects them. So as an entrepreneur, I think you have to figure out, okay, do you have money to invest? Are you going to invest? Have you invested anything? Are you going to waste my time? Do you have some cachet with your mothership so that you can get them to pay attention and be my sponsor? And finally, what is your decision process? That's a fair question to ask. Like the last couple of investments you've made that weren't slam dunks, how did that go down? Who did you have to convince? What obstacles did you overcome?
So just in terms of looking at, what you invest in, so to forget the kind of the roadmap, but in terms of when you're investing, are you using the same criteria as a VC, for example, the team, the product, or is it has to fit into the roadmap? Like how do you view that? How do you look at what are what's the criteria you use when you're evaluating startups?
So I'll qualify my answer by saying I'm giving you my answer, but it's not necessarily true for all corporate VCs. That's the part of the complexity here as an entrepreneur, is that corporate VCs, there are many more animals in the corporate VC zoo than there are in the financial VC zoo, or species. So in my particular case, we made decisions based on the typical venture capital criteria. And all the stuff that you can read about as a common mantra. We didn't, unlike some corporate venture firms, it didn't necessarily have to be on the roadmap. So yeah, let's just leave it there. Now, I understand, I guess another sort of inside baseball tip is that as an entrepreneur raising money with a corporate venture firm, it's important to understand where is that firm in their life cycle. In years 0 to 3, particularly the first year, they shouldn't be doing ideally, if they know what they're doing, they're not making crazy investments that they won't be able to explain later when the CEO transition happens in about year 3 to 5. Years 2 to 5 are when something's going to happen. The corporate venture firm will be called on the carpet by the new person or the CFO. Answer the question, what the hell have you been doing? I don't understand any of this stuff. We should get rid of you all. You're fired. See you later.
Right.
And so where they are in their life cycle is controls the kind of investment risk that they're willing to take. So I would say early on in the life cycle, they're probably looking for safer bets that are more aligned with the strategy. Later in their life cycle, when they've earned some stripes or some reputation with their mothership, they can make investments. They're willing to make investments that are a little bit off strategy. At least, they're making educated bets about, the company ought to have a strategy because this is the way the world's headed. So in GE Ventures as a whole, we had 35 investment professionals. I tended to stay pretty close to the GE Digital roadmap until for the first 2 or 3 years. And then I started to tell them what ought to be on the roadmap because I knew what was coming. And then later they put me on what's known as the red team. So every year there's an annual strategy process and the managers of the company invent some plan for the future. And my job was to kill the company off, to kill GE Digital off by, assembling whatever could happen from competitors. So that we would put the two strategies together and hopefully be better. So different parts of GE Ventures, particularly the healthcare group, tended to invest way out ahead of GE Healthcare. Often when GE Healthcare heard about the investments that our investors were making, they would say, that's a crazy idea. Why would you do that? It's not relevant to any of our businesses. And about 3 years later, some new person would show up and go, this is great. Thank goodness you guys are investors. This is totally on the roadmap now. Let's buy this company. So you start to get a feel for your own company about how long it's going to be before the light bulb goes off, no pun intended. And somebody says, oh, yeah, I guess we do need something that does that.
Yeah. So in terms of investing, what is common in terms of which stage do corporate VCs generally invest in? I assume that's a pretty wide question. But in the case of GE, where was it? Seed? Was it late? I know later for sure, but where do they?
In the case of GE, it bifurcated. So again, when you're early in your life cycle and your parent company doesn't trust you enough, they generally don't let you do early stage things because those are perceived as, ironically, risky, although the payoff can be quite high. So they want you to do safer later stage things, the Series C or D that lots of other venture capitalists they've heard of are in the deal. Unfortunately, you don't make much money if you do that. So it's a safe bet, but maybe it doesn't have a visible payoff. We started to bifurcate, and just because of the way the world was evolving, I was able to make several seed investments in companies that I had a sort of inside knowledge about the market requirements and when the market was evolving. And the managers at GE Digital and the rest of GE could agree with that. So I had simpatico with the strategy at that point. I could see that that's where the world was headed. And we also, as you mentioned, we did some later stage things. Like I did a growth stage investment in ServiceMax, which eventually turned into us acquiring ServiceMax for $1 billion, I think.
Yeah, I remember that.
Go ahead.
Oh, so I was just going to say, in terms of just one last question on kind of the startups engaging with them, and I want to talk a little bit about the industrial IoT and kind of that market. Are you looking at the same metrics that a financial VC looks at when you're evaluating a startup? And what are the metrics? And I mean, you've kind of answered this question. I was going to say, do you need buy-off from everyone, including the person who needs the help? But it sounds like in your case, you didn't. You could make an investment on your
own. Okay, so I got to qualify this one a lot. We look at metrics to the extent there are metrics. We often look at the same metrics. But for very early stage companies, there are no metrics that make any sense, right?
Right.
Because if you think those make sense, you're wrong.
Totally.
The metrics that make sense for a seed stage company or a Series A company have more to do with, is the market validating, do the dogs like that dog food? And later you get to be clever about pricing it and maybe tweak your business model to accelerate growth. But there's some very sophisticated SaaS metrics that only make sense if your run rate is 5 or 10 million ARR a year. Until you get to that point, whatever conclusion you draw from those metrics is like, wow, that metric is really different than last month. I don't know why, and it's going to be different next month after that. So it's not very diagnostic. What we looked for was validation from the market, and frequently that was, first, do we think there's good, some need inside GE in the near future? Did GE's customers, would they pay us more if we had this widget somewhere in our solution? Okay, maybe they would. Do our competitors, who are another good proxy for the market, are their customers also seeking the same thing, which is almost always the case? Is the global industrial conglomerate the only market segment, or is there some other market segment to reduce the risk? Because selling to GE and Siemens is a real pain in the ass. It takes forever. So, we'll look for those kinds of early stage things. Fundamentally, it boils down to, does it solve a problem that somebody has? Do they know they have that problem? Do they want to pay anybody anything to solve that problem? Or do they just rather not ignore the problem and go away? Right. Later stage, there are some metrics that have to do with, you're probably going to ask me what's hard, but in the investment portfolio that I have, the startups that sell into the industrial IoT space have a really challenging time leaving the POC phase and crossing the chasm into signing an enterprise contract and getting paid on a regular basis. So the initial cost of customer acquisition is quite high, because each customer engagement is a long romance with many dances and so forth, and it's not easy to rinse and repeat those. But eventually you hop out of that and you get to say to the next customer, it says, well, I don't know, let me kick the tires, give me a free POC for 9 months and I'll tell you how I feel. You get to say as a founder, no thanks. If you don't trust that all your direct competitors are already using this, that isn't enough validation. If you can't read these market reports, or you don't see that my investors believe in me, I think you need to roll around on the barbed wire a while more. Essentially, you can't afford to waste your time with somebody that wants to get you into that situation. And you can hopefully, leave POC purgatory and get into the, presumptive close. I need to know that there can be an enterprise contract in a fixed amount of time. And I have this elaborate qualification criteria, which you seem to tick all the boxes. So I need to know that you can close and you can finish your evaluation in whatever it takes, a month or something. That is a real, in a sense, that is a metric, but it's very subjective when it happens, and it's different by market segment and technology where you are in the stack. But it's a big milestone. If a company can transition there, they have a whole new set of challenges, but at least they're not going to die in the crib. It's going to be a different set of hurdles they face.
Yeah, no, I resemble those remarks with Norego. It's very true, right? And yeah, once you get past the pilot purgatory with one significant customer,
Yeah.
you can control the discussion with the next one. And yeah, no, that's actually really good advice. So you talked about your investment. So I was looking at the list. There's a lot of AI, data, and security investments. Just in terms of industrial IoT, industrial internet, industry 4.0, call it what you want. Where do you think the opportunities are? Are they kind of focused on specific verticals, or focused on, let's say, a generic AI platform or security? Just based on what you've seen and knowing what's going on inside of companies like GE, where do you see the future?
A different way to say that more explicitly might be, how do the people that finance these companies, it's like fashion trends. What's the new black, right?
Yeah.
And the audience is people that write the checks, because they don't have perfect knowledge, but it is
Right.
sort of a forcing function.
Yeah.
And these fashion trends in technology investing tend to follow a pretty common cycle. They often start with hardware, but I think we're way past that. They switch to commercialized techniques that people learned when they were in graduate school. So they're open source versions of AI analytics or AI techniques. They eventually transition into generic platformness. It's there isn't an all singing, all dancing platform, but there are some that try and do that for a narrow slice of the market. But I think we're way past that interest as well. It seems there's still interest in point solutions to some of the real big sticking points. Like you mentioned, data, the journey that data takes, industrial data takes, from where it's sensed to where it's stored in, say, data historians or other systems of record, how it's combined, because it's generally siloed and not intelligently combined in a way that analytics can use. There's just some real simple problems that get horrible at scale, like industrial data, instead of having a sensor named, it's stored in a database, but instead of having a field name, it's often called a tag. Same thing, it's a field name. But if you have 10 years of data from hundreds of sensors or thousands of sensors in a complex factory, odds are somewhere in that 10 years, somebody replaced a piece of machinery that has sensor with a new piece of machinery. And they may have changed the name that they refer to that tag by. And so all of a sudden, you've got 4.5 years of data that made sense because you think you understood what the tags were. And then all of a sudden this name changed. There's this new name. What's that mean? Why is it organized that way? There's the hierarchy of the data. So if I call it the million sock in your drawer problem, millions of socks. Just organizing, it's as a guy, it's far easier if you reach in and you have socks that are paired. You know what to wear. It's not too hard if you just have 5 pairs of socks. You could figure that out, even if they weren't paired. But if you had 10 million pairs of socks and they were all different, it might take a while to find a matching pair. And that's one of the problems in industrial data is this kind of needle in a haystack issue. Anyway, there's a series of problems like that where point solutions or platforms to organize the data better, contextualize it is kind of the fancy word for analytics later, is still being invested in. And there are, generally speaking, analogs in the enterprise world that warm the hearts of venture investors, and that's why they invest in those things. As you go up the stack, the you get paid more as a company to do sensing the data. You get paid something. Organizing and sorting the data and contextualizing it, you get paid more. Cleaning it up, you get paid some. But as you go up the stack and you do something valuable with the data, you get paid more and more. And so the investments have tended towards companies that don't just use AI. It's not an AI technique, but that they actually, in some sense, they're a vertical solution that comes to a conclusion, like take the red pill or take the blue pill, or and maybe they can explain why that conclusion. It makes the suggestion based on a prediction or a series of predictions. Those systems tend to be very valuable. And you just look at the IPOs of Palantir and C3, and you can get some sense of where a company like that could scale. Now, it's very expensive to build a company like that, but reasonable customers are paying $1 million, $5 million, $10 million a year for those kinds of solutions. And they generally, they're saving money at that scale as well, or else they wouldn't be paying that. So it's moving away from narrow platforms and to generally solve a business problem, which is almost always some narrow. It's a full stack, but it doesn't do everything. It just does whatever it needs to provide the solution at the top, which is often some clever interpretation of the data, maybe uses AI to make predictions or some other more straightforward techniques. But it solves the business problem.
Right. Yeah. Your example with the tag, another kind of similar thing that I noticed, especially after joining GE, when you have multiple industries, every industry has different types of assets, different replacement cycles, and trying to build a generic thing that goes across all of them is super expensive and takes a long time. I think the narrow focus to start with is very good advice. So we're at the top of the hour. I have a couple more questions. If you guys have any questions, add them to the chat window and we'll go through them. So in terms of, IoT, I saw this statistic in PitchBook that investments in IoT went down last year. They were down 19%. I don't know if they're looking at consumer or industrial. There's also not a lot of VCs that you can go to. There's more and more that are focusing on industrial. What would you say in terms of kind of if I was an entrepreneur and I wanted to engage with the fundraising community, where would I start? Would I start with the VC, corporate VC, if I'm going to have a customer that is industrial? Who should I go to first?
What does your company do, and who's the customer?
So industrial, right? So industrial. I guess what I'm asking is, is there a benefit to going to a corporate VC than to a VC first?
Who understands the value of the solution you're providing better? In some cases, there are a few institutional VCs that really are good and they get it. I have a very good friend who co-founded G2 Venture Partners. He left Kleiner Perkins, and David Mount is his name, in case you're interested. And the premise of their new firm is to bring internet technology to industry in creative ways and disrupt it. It's a really broad mandate. It's not solely focused on industrial IoT, but he was on the board at OSIsoft. And he did start, and we are co-investors in another data cleanup company called Element Analytics. He understands what OSIsoft is the company that makes the data historian, but they have many, many, many industrial customers. So he understands the problems that those customers have and the solutions they wish they had. That's why he seeded and started this other company, Element Analytics. I think he gets it much more than, I'll just go out on a limb, much more than any other VC I know, institutional VC.
Yeah.
Plus, there's the added trivia that he was on an episode of West Wing when he came out of college, which is a sort of trivia thing. I was binging the entire corpus of West Wing and saw him in there. Went, what the hell? I had to call him up to see if that was him. So there aren't many institutional VCs at that level. Anybody who's made, so there's the people who invested in Samsara that are pretty good. And then there's a whole nother parallel universe that's relevant in the supply chain and logistics world, because that's also relevant to industrial companies and occasionally uses IoT to collect data. So on the other hand, not every industrial corporate VC gets what you're doing or cares or has the same connection and persuasion with their mothership. So sort of like who's got an investment arm that cares about what I'm doing. There are some other new institutional firms where they're not corporate, but they're related. 40 North is funded by money from Standard Industries, but they have industrial focus. There's a small group of clubby industrial VCs. We all know each other in the Valley.
Okay. Yeah.
Swisscom has a industrial IoT fund. At least they're a limited partner in one in Europe.
Swisscom.
Momenta has a seed fund. Momenta is it's both a search firm and an advisory firm, and it makes seed investments in some of its companies as well. There's startup accelerators. So it is very situational. I can't say like I could go talk to Greylock doing this kind of thing. Because really what it boils down to is less the firm and more who is the person that gets me and what company I'm trying to build and the business problem I'm trying to solve. There really just aren't that many. It's a very short list of people that could be receptive. And so you just have to kind of ping all of them.
No, that's very true. I mean, there is a small group of industrial or investors who understand industrial. It's very small. It's actually one of the reasons why we started doing these meetups to try and kind of focus because we have a lot of startups that are going to whoever is investing and
and they either some focus like I did exclusively on those markets, and others, sort of a Venn diagram. They are willing to take a risk on a company that participates in that market. Maybe they're not solely focused on industrial customers. So you'd have to give me the company in more detail about it before I can handicap. Talk to Louise over here or Sam over there.
Right. All right. So I have my last question. It's kind of a slightly multi-part question, and then we'll switch over to the audience question. So, out of all the investments you've made in industrial, which one's your favorite? Like, which one's your favorite where you really geeked out? And then, which one's the best one in terms of an investment that really took off that you didn't expect? And what's the worst? And what did you learn out of all of those?
I can talk about some favorites.
Yes, that would be awesome.
One favorite. I don't have just one favorite. And I can refer to a situation that didn't work out, but without naming.
Of course.
Or maybe I can just create a collage of things that didn't work out and give you some reasons why. Because so the things that I have liked tended to get these things right. They more than anything else, they had good timing with respect to the market, which is luck more than anything else,
Mm-hmm.
or luck and a lot of coaching from somebody like me who happened to know what was about to occur in the next year.
Mm-hmm.
And I wanted to, in the surfing analogy, sort of paddle out and get in front of the wave as opposed to just wished I was on it. So I think I still believe that the most important thing that I invested in a company was not money, but
Mm-hmm.
market requirements and market timing.
Yeah.
Because in hindsight, if you go talk to somebody who's founded a company and you ask them who's ever pivoted, what would it be worth to not have to have pivoted?
Exactly.
To have done it right the first time. It's like, oh man, that would have less gray hair.
Yeah.
I could have avoided a layoff. I could have been wealthier because I didn't have to sell as much of my company. So it sounds impossible, but getting market timing right and getting lucky was very important. They're all educated guesses on my part, but then it's a bet on the execution risk of the management team. Can you finish the secret sauce in 12 to 18 months and catch the wave, or are you just going to wonder what happened? The other thing was that there's almost always a strong technical founder who can figure out how to build a team that manages the engineering risk. But it's coupled with usually the CEO or some other co-founder who really understands the customer problem. And then the third element is that it's usually the CEO or someone who's the chief persuasion officer. Because in the early days, usually no big company wants to give you the time of day or doesn't believe you'll ever pull off what you're trying to do. It's very humbling to search throughout a company and try and find the receptor site if that's not entirely obvious. And often that's feedback that you have to take and say, well, maybe I'm solving the wrong problem. Maybe nobody cares, or nobody has money. So the ones that have worked out have the timing right. They had the product ready when the market happened, but they also had these persuasive people who were generally the leaders. They had a leadership position who could persuade a customer to take a risk on them, and do a evaluation. Share my vision. Wouldn't it be great if we could do this? I know you think it's challenging, but wouldn't it be great if we could? So in some cases, those have worked out fabulously. Several of my companies have been acquired. Several have had multiple offers of acquisition and have decided to wait. But it's really good. They're starting to accelerate. There's one company I'm thinking of that went from single-digit ARR to double-digit ARR overnight. And I remember the board meeting where we were seriously discussing how to not cook the books, but how to somehow lower everybody's expectations for revenue momentum, just in case they couldn't keep up this big surge in growth, which is exactly, I guess, the kind of problem you want to have. It's like, things are going to look too good. How do we keep up this pace? We don't want to look bad. So we started sandbagging all the revenue forecasts and trying to under promise and over deliver. And then things kept picking up. So the failures, it's a variety of things, but it often is it's often associated with the senior leader of the company. Eventually it all comes down to that person. Sometimes you just get unlucky and you run out of cash. You can't figure out, you pivot a couple of times and the dogs don't like the dog food. I see somebody in the middle of the screen here has a picture of a dog. That's what made me think of that analogy. But that's one of my favorite quotes. But other times the CEO, for good reasons, is the last person to let go of the vision that the company should be heading in a certain direction. And so the intellectual honesty of the CEO not that they're dishonest, but that they may not be honest with themselves about what the feedback is telling them, gets them in trouble. And so a couple of cases, I share responsibility with things that, with the CEO, when things didn't work out, because it's partly my fault to not have raised the issue sooner, but then totally their fault after I raised the issue, and they continued to head off in that direction, and then drove off a cliff because, I could see maybe before they did that this was the wrong direction to pursue.
Right.
So that's often, but that's a standard venture criteria.
Right.
Very often when you invest in a company, you're trying to judge the leaders of the company and understand, will they know when they've made a mistake? Will they acknowledge that? Will they be able to change course, or will they just hide everything and it'll blow up at the last minute in the worst possible way, which is undesirable, believe me. The best kind of CEOs I've had, the ones that have done it before and shine, are people that, when it all comes down to how do they deal with bad situations, but when something bad happens, they're the first people. They call me before I call them. They say, there's a problem. These are the issues. I can control these 3 things. This last thing I can't control, but I'm going to keep my eyes on it. I've already taken the steps that you've thought of, control cost, this, blah, blah. And they make you feel like they know what they're doing, and they're not, panicking and trying to get in the lifeboat before you know what's going on. So I guess sort of steady hands in that respect.
Yep.
Anyway, I've been talking a lot, just going on. We probably have lots of questions.
That was actually really helpful. All right, so I'm going to switch your questions. There's actually 3 questions. One's a comment. Vishwambra, I hope I didn't butcher it. Do you want to add any context to your comment here? Looks like you're going back and forth between corporate.
Sorry, Hans. I go by Vish. Thanks for pronouncing my name. I have a short name, but I apologize. There's some work going on here in my house. They're trying to remodel my bathroom, so you might hear some noise here. But I've worked for Boeing for about 10 plus years, being in commercial aviation, and I can very well connect to what Michael said. I've been in fleet support as well, looked at the service aspect of how we work with airlines and what's going on. And I've tried to be very innovative, try to do things quickly and in a very innovative manner, which doesn't go very well with the corporate structure. But, I got out of that, and I also worked for Boeing supplier HCL for a while, and been on the path of startup. Last 1 year, I struggled quite a bit. I did a little bit of real estate as well. And then I was at a tipping point where, again, they called me back in corporate. I came back to Boeing, and right now with the commercial aviation situation, I didn't last there even for 6 months. So I'm back on that path now. So thanks for having this, Hans. It's really nice to get connected and understand and see how founders are doing and how they're investing. And I'm in investing front as well, working with some of the incubator capital companies both here and in India. So I would like to connect with you, Hans, and with Mike and talk more. So thanks for having.
Of course. No worries. That's actually a pretty good example in terms of if you're inside of a company and you're trying to push a particular solution or whatever it is, and you can't get them, but customers need it. That's a good signal that maybe you could go raise some money and do it yourself. Yeah.
Ironically, there aren't as many old farts starting industrial IoT companies as I would have expected by now. It could be because there aren't that many people that are both familiar with the struggles that customers have with their own data,
right,
and people leaving to start companies. It is a cycle I've seen, but it isn't as common as it is in the other areas of technology where, like ad tech and social networking, where it's super common.
It's you're right. I mean, I think, I mean, that was something that I actually noticed with definitely inside of GE, where people with a lot of experience they didn't want to take the risk, but they had the knowledge and knew what the problem was and what the solution was, but couldn't get support.
Yeah, generally speaking, the highest paid person isn't going to leave and take the risk, but the person that wished they were paid more and or at least had the independence to call their own shots and is connected to the customer.
Yeah,
I mean, I've seen it happen. It's just starting to happen now, I think.
Yeah, no, that was something that Len Jordan from Madrona on the meetup we did with him. One of the things that he said was generally when they see founders from bigger companies, they tend to be director level or below. They very rarely see anyone above a director level going to start a company. So that's very true.
I'm looking at the questions. Could I answer the most recent
Mike?
one?
Yeah.
Well, I can get the mic in a second. Mike knows me. We can talk later. But, Bill Messing asked a question about IP. I see at the bottom of the list.
Bill?
Yeah, I'm actually in a position right now where I have interest from a corporate VC in reviewing a bunch of information on my company, and I'm just going to circulate it internally. And these very same people, because it's kind of complimentary, might just decide, wow, this is just what we've been looking for. Thanks a lot. So what's the path to kind of keep from just giving away the store?
So I used to deal with this a lot, and it depends, again, is my favorite answer, but as an investor, I'll take the other side, which is, in my experience, the people that are most anxious about protecting their special IP, source extremely cautious, generally have the least interesting stuff worth investing in. It's generally true that institutional investors don't sign NDAs, but that's mostly because they don't feel like they have to. The power equation is pretty much in their favor. It varies quite a bit with corporate VCs. So we had NDAs quite frequently that I agreed to sign, but I think that's because things were carefully compartmentalized, and it was pretty clear that even though I'm a technical guy, my ability to exploit the company's unique IP, because I was peripherally exposed to it, there was a Chinese wall between us and the rest of GE. I spent more time trying to keep our own research lab from inappropriately exploiting somebody's IP than something else. So there were a couple of situations where, they were, anyway, I was policing our own behavior about my startup's IP. So I think in the end, it kind of boils down to the reputation of the corporate VC and the company itself. So there are some companies, and I won't name names, I'll let you figure out who they are, or I can talk to you personally. There are some large companies that have a reputation for ripping off startups. And then there are other companies that have a reputation for being straight arrows and behaving. And then there's, everybody else is on a slider somewhere in the middle. And so you do have to do your homework. And it may not be a good idea to talk to somebody who could directly benefit from and exploit your IP if you just disclosed it to them. Usually the corporate investor doesn't need to know in much detail what you're doing, only that you've taken steps to protect it so that you preserve your freedom of use, freedom of action later. And the fact that you have a patent is great. You probably can't afford to prosecute it against anybody, though. So what good is that, right? So as an investor, I want to know that you have good hygiene and do things prophylactically, but I certainly don't expect that you're reserving money for future lawsuits, because that's not the way I want you to spend my money. Does that answer your question?
Yeah, I
guess
know
I
it's a
talked all around
noble.
it, but
There's no clear answer, obviously, and a lot of it's reputation and you know, the introduction.
You can reveal things that don't. I mean, if they refuse to sign an NDA, you can only open one veil of 7 veils, so to speak, right? Maybe that's a crude analogy, but you don't have to expose everything. Anybody that says, I need to see your source code in detail is probably suspect. Really a bad idea. I think most large companies, I'm speaking on behalf of GE and some other former employers, they don't want the exposure. The last thing they want is for them to be exposed in a way that, because it would cost them a lot more to defend themselves, even if they had to. So they're trying to avoid the risk. I guess I don't really understand your situation and why they.
It's in a foreign country, so the patent coverage isn't there.
No.
Well, that's another ball of wax. So foreign companies, depending upon which country, have a variety of behaviors towards startups, which, it's kind of, you have to be very cautious sometimes.
So
Longer conversation, but thank you.
Yeah.
Actually, so that's actually, Mike, I'll come back to you because this is actually a good good follow up from Aaron on globalization. Aaron, are you still with us?
I am. Yes. Good evening. Good morning, wherever people are these days.
So you're somewhere in the. Where are you today?
China.
Oh, okay. So Aaron is an investor all over the globe. A lot of experience
in China, isn't it?
Yeah.
5:30. Yes.
So go ahead, Aaron.
Yeah. No, the great discussion, and I'm based in now in San Jose, California, after many years in Seattle. But when I started my career in the early '90s, you pretty much captured your domestic market, for me the U.S., until you even thought you would do that for maybe even decades before you thought about international markets. And particularly when it comes to IoT, industrial IoT, the world is flat in monetization opportunities pretty quickly. So with that said, I'm kind of curious, Mike, from your perspective, both on the technology side and the investment side, and you're with a global company. How quickly do you think companies should be looking at foreign markets as far as monetization and customers? Either industrialized markets like Europe, which has we talk about IP protection, which has modern, robust mechanisms, or emerging markets. We can there's always, of course, China, but example, and Hans and I've talked about this. Africa is a huge market. GE is looking at Africa, a lot of companies, but they're competing with the Chinese companies and other players in that sense. So I'm kind of curious to get your thoughts on that.
Well, it depends on a couple of things. Generally speaking, a company is better off focusing its first market on whatever country it knows the best and the cost of engaging with customers is the lowest. And so that's why many US-based startups start off at home, because it's cheaper to find customers. The further afield you go, the more expense you incur unless you have some secret weapon. Now, a couple of my companies did extraordinarily well in Japan, but that was because they had a secret weapon, bilingual Japanese, dual citizenship, Japanese American guy who culturally could be both American and or Japanese whenever necessary. And so they just got lucky that they hired this guy. I think he came from Cisco. If you don't if you don't have good guanxi in the Chinese sense, if you can't establish a relationship in that culture and understand whether people are serious or not, it takes longer to close a sale. So the second most common market for U.S. startups is industrial ones, is frequently Europe, although there's generally some analog of everything that we do here started in Europe about 6 to 9 months after it starts in the United States, if not simultaneously. So there's kind of you're not the home team problem in Europe. They wished you were more European. So once again, it helps to wrap yourself in some flag of a European country. It's much better to be represented in country by someone who speaks the language and knows the culture, just as it is in a variety of countries in Asia. I would generally not recommend Japan as a first market. In fact, I would always recommend Japan as not a first market, unless you had this kind of thing in your back pocket where somebody really understood the situation. China has its own, set of intellectual property issues, which you have to be very cautious about. Also payment issues. So sometimes, depending upon where we are and which presidential administration and whose trade war is doing who, sometimes it can, I've had a number of companies that can't get paid on from their Chinese customer because the money is in a bank in Hong Kong and can't be wired because somebody physically has to go to the bank in Hong Kong, but you can't go because of COVID or some demonstration, or it's just a million excuses. So I don't know if that's true or not, but it certainly has delayed payment. So there are, I guess, if I was looking at investing in a company that was based near me, but chose its first market as way far away from here in a different business culture, I'd consider that a significant risk until proven otherwise to me. And I'd be looking for, how do you know that business culture better than me? And how do you know that customer problems better than me? And who's your secret person that can, find out what's really going on outside? Because each business culture has its own way of having a side conversation. So they may tell you one thing, but you have to go have coffee with the French at 4 p.m. outside of the office to find out what's really going on, because things can be very political. Each business culture has its own little routines.
So I actually, just related to what Aaron was saying. We recently had a company, Zipline, and if you're familiar with them, they build those drones. Aaron mentioned GE selling equipment everywhere, right, including Africa. The world is their oyster, if you will, right, in terms of where they can sell the equipment. And for industrial, I like the analogy of world is flat. Everyone's trying to do the same thing. It's mostly the same equipment. So would you actually look at investing in let's say in Kenya?
We did look at investing in Zipline. It was just too expensive by the time we saw it.
So I know the person here who wrote their first check, and it wasn't Zipline. I mean, it was doing completely different. But yeah, so go ahead.
The reason that we chose not to invest in Zipline for a variety of reasons, but the easiest one to describe was too expensive by the time we paid attention.
Yeah.
The more complicated explanation is we had a disagreement at the strategy level about whether that kind of company is the right bet to make in how the UAV market will evolve. We have made different investments in UAVs. Like we invested I was on the board of a company we started.
I remember.
Let's call it the future air traffic management system for unmanned vehicles.
Yeah.
Which, if you think about it, is going to be a real problem, because today thousands of aircraft are coordinated by hundreds of humans that talk to them. That's not my dog. Hundreds of humans that talk to them, then hand off control to the next cell. But when you have hundreds of thousands of UAVs delivering sweaters or organs or medicine, there's more. That's sort of beyond human capacity. So how do you automate that was an issue that we focused on. So we kind of went for the platform level thing rather than, I bet this company can figure out how to make a cheap thing that flies and a business model to not go broke before that company can. And
because they started in Africa, right? I mean, they're in Rwanda.
Yeah, but it's not an African company. It's just they started. I mean, I don't think that was even their first choice, but it kind of wound up there because somebody understood that there were no regulations in their way.
Yeah. Nobody
cares if a fixed wing aircraft that weighs 10 pounds crashes somewhere in that part of Africa.
Yeah.
Odds are nobody's going to get hurt. And so you can launch it with this giant slingshot and not worry about it because there are no regulations there. And you can catch it with a huge net because they don't care if anybody gets hurt there. And, you can deliver critical stuff because people do that. But I don't think that same model works everywhere.
So, but would you invest in a company, let's say in Kenya, in Africa, in China? Like, what was your scope? What is?
We had no restrictions.
Okay.
So planet Earth was one of the restrictions.
Okay.
We invested where the most relevant innovation happened, which is generally, we had offices in Silicon Valley, Boston, Houston, China, Tel Aviv, and then we kind of had a roamer throughout Western Europe. We almost opened an office somewhere in Western Europe. And we came very close to opening one in London, Paris, Munich, somewhere. Because there's enough innovation that was relevant to us to be there. I think the most significant place outside the States for us was Israel by far, just given the velocity of innovation that happens there.
Yeah.
And the support ecosystem for building a company in a hurry, figuring out what the market, what dog food the dogs really want before the company runs out of cash, and then pivoting, they've got that down pretty well in particular for certain technologies.
Yeah, totally agree.
I looked at companies every company in Europe. In some places I didn't know had IoT expertise, like, a lot of places in Italy. I wouldn't have suspected. They're great places to go cycling, but not necessarily I would have suspected IoT hotbeds, but they are. All over France, the UK, Northern Europe, Germany and North and Scandinavia. We were asked to open an office in Brazil because of the tremendous innovation there, but we just couldn't quite figure out how to staff it. And so it was a little bit early for us there. And I thought we felt innovation there was not radically different than innovation elsewhere. So we weren't trying to promote innovation in a particular place. We were trying to exploit it happening in a certain place. And so usually we could just pick it up locally. Although sometimes Israel was doing very interesting things before it happened in the States.
Yep. Yeah, I agree. We're past our time. Do you want to take Mike's question? It's actually C3, pretty relevant. Let's do Mike.
What do I think about the C3 IPO? Is that the paraphrase?
Mike, you still here? Oh, there you go.
And in particular, this aspect that Microsoft and Coke were the two real sponsors of the IPO. And so when you start looking at where C3 is in a business world, with it seems like they've sort of found that niche that we've all been looking for. So I was just curious on your thoughts, because I know you've almost every company you've been involved in. So.
I know Tom Siebel well enough to give him shit. More power to him. Congratulations. I didn't think he would pull that off. I think given his revenue momentum, I can see how he did. I think the Palantir IPO softened things up for considerably. So I'm not sure. Perhaps he would have gone public anyway, but I think he was able to go public at this point in part because Palantir paved over some of the concerns that people have, even though they're different products. Both those companies aren't profitable, which is kind of unique for this point in tech public IPOs.
Yeah.
So the market is, particularly during a global pandemic, the market is back to forgiving companies that aren't yet profitable, but have a good story about revenue momentum. Like, I could be profitable if I wanted to, is kind of what they all say, right? But I should continue to invest in growth, and I don't need to be profitable right now. Please, please give me more money. There are I wish there were more companies like it, because then I think there'd be more investors in IoT-based solutions. I know all of the warts of the company, but I think he's done a tremendous job, and he is an awesome salesman himself. So he is the face of the company. He has a good team, but he also represents the company quite well, and he's super well connected. So I think he's built a good syndicate that paid off. I hope that IPO, I can't really speculate who would be next, but I think there's some other companies that are on deck that hopefully what this does is start to set off a wave of acquisitions, because if large companies think, if I don't acquire this company now, it might try and go public, and then it would be much more expensive to acquire later. Maybe I should acquire it now. And I don't know if that'll happen or not, but my fingers are crossed that maybe it might. So I like what he's done. I like the platform. I think it's not the all singing, all dancing platform, but it is an example of a platform that nobody just buys the platform. Let's be clear. Everybody buys a solution that somebody has built on top of the platform. So they have a platform story, but I don't think they sell the platform. They don't sell the box of Tinker Toys. They sell the thing they built out of the Tinker Toys for you, and it works well because it's a platform. But so that hopefully finances them further. You mentioned their support from Microsoft. I do remember when they've had support from everybody. They just sort of leave some people at the altar. Like, I think AWS was their partner early on until they switched. So Tom's a smart guy.
All right. And then I see there's a comment from Eric about us old farts here. I think he was referring to when we were having the discussion about people from bigger companies are leaving.
It's that there aren't success. I mean, there aren't people who understand, who have experience, and are leaders and have intimate knowledge of some significant customer requirements, that then leave and start a company to solve that problem because the big company wasn't getting to it.
Yeah,
that's the classic script that we like to hear.
Yeah,
is somebody sees a huge problem, understands it's unexploited, knows that they can build a solution and come to market in less than 24 months, and it's not inconceivable they could pull it off. And they basically reduce all the risks to just give me money and I can win.
Yeah.
There aren't enough of those stories yet, I think, for the rest of the institution, and then take it forward to success, which I think is the most important part.
Right.
There aren't enough of those stories yet for many institutional VCs who are just really good pattern matchers to go, oh, I guess that ought to be my next specialty. Although, as I was telling Hans before the meeting started, based on the number of people in institutional VCs I know that are hitting me up to have coffee and talk about all these issues we've just talked about, I can tell, there are a lot of people, what's it called? The phrase, hanging around the hoop. I mean, they're kind of trying to figure out if they should jump in and participate. They're almost there. And I think the C3 IPO and the Palantir one helps a lot, particularly C3, because it's a little bit easier to understand than Palantir.
Yeah. That's awesome. Thank you, Eric, for standing up for us old farts. All right, there's no other questions. We went over time quite a bit. This is actually our longest meetup we've had, a virtual meetup. So thank you,
great.
Mike.
I know there are only 2, but I'm glad to be winning so far. That's good.
No, this was awesome.
I'm an junkie, so I'm into that. That's good.
The double points.
Okay, good.
But thank you very much. And if you're welcome anytime. If you know of other people who you think would be good for us to have and who are willing to share, let me know. And otherwise,
maybe I'll run down my list of favorite co-investors and see there. We do this all the time, so I'm sure there's some other people I could give you.
Cool. All right. Thank you very much, everyone. And thanks, Mike. And
it's been my pleasure. Thank you for having me.
And have a good day.
Okay,
bye, guys.
Cheers.